What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is July 4th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, and happy 4th of July to my fellow Americans. In today's macro analysis, we're going to be spending some time to dive in through a few key topics. We'll start off diving into crypto, talking about why the typical optimistic bear market bottom indicators aren't reliable enough in this environment. And outside of that as well, we're going to be diving into what's going on in the equity markets, Forex, commodities that could signal more pain to come here, and why we need to aim to be patient during this period of time. All the while, we are looking for some opportunity here in the coming weeks and months, depending on how the market conditions change. We've got lots to dive into today's video. If you guys like it, consider dropping a like, and let's go ahead and kick off the conversation here. Now, I want to go ahead and start off here with the Bitcoin chart. This is a long-term logarithmic chart here, showing generally the kind of range long-term that we look for entries as well as when we take profits. This again is adaptable over time here. It will change a little bit here. Sometimes we'll deviate slightly below or above either band. Maybe we may not revisit all the way towards one of these bands in the future, but it gives us a good understanding here of where we could start to find value opportunity. And whether you're looking at these bands or the typical percentage declines we find during bear markets, we can see here that all the while the correction we've gone through has been brutal, as per typical bear markets here. We can see that we only from top to bottom have gone through a 74.8% correction. And it is important to understand here, and this is sometimes a thing that many people misjudge, is that just how much an additional 5-10% decline added on there, like we typically see in most bear market corrections above 80%, just how much more that means we have to go down in price. So that's a very important thing to understand here when we're considering the dynamics of bear markets. And I know a lot of people as well would point out to the fact here that we have gone below the 200-week EMA or the 200-week simple moving average. And yes, typically this has been an area where you can find some discount opportunity. And as I mentioned before on the channel, there's nothing wrong with dollar cost averaging, but do it slowly at the start and pick it up heavier and heavier when we get lower in valuations. It's not important right now to focus on rushing in to catching a falling knife. In fact, as we talked about before, if you're going to be trying to trade these cycles, as we talked about in yesterday's video, and if you hadn't seen that, I definitely recommend going to check that out if you're trying to capture a bottom or really kind of go all into the market. We want to wait for the signs of confidence to signal that the trend is ready to reverse, rather than just trying to catch a bottom. So we believe here that Bitcoin has got more downside to go. And outside of that as well, when we're talking about Ethereum, we see the same exact trend here. We think that Ethereum is going to continue to climb lower here in the longer term trend here over the coming weeks and months. Now, I do want to be very specific on something, which is that in the short term, we could see some minor relief rallies, and we'll talk about that in a moment. But if you're really thinking about those macro cycles, which we like to trade here, we're simply looking here for a good range to start building some solid entries. Again, those kind of generational entries that only come along every couple of years that'll give us an opportunity to make some sizable returns. And like we did with Bitcoin, taking a look from top to bottom here from back in November towards the recent lows here, we've only been down about 81.95%. I know it sounds like a lot, but if you take a look at the previous bear market here, albeit in a period of time where asset markets were much more optimistic, a 94.6% decline. And again, let's go ahead and visualize, just to put it in perspective, how much lower it would mean if we even just came down to a 90% correction. If we came down to a 90% correction, that means we're going all the way down to around $480 in price. A big deviation and difference from where we are right now at $1,051. This is again why all the while DCA can be a very powerful tool. We cannot let it blind us towards catching falling knives. And DCAing over the course over a week or two can leave us buying a really expensive price, and therefore probably trying to get out of our position, and then the market spikes up and we get back in, and then we start revenge trading. It's a complete mess, and most people don't have the discipline unless they really dollar cost average over a long period of time. Only if they have a couple dozen or $100 of exposure out of each week, and they know that they've got that repeated pattern on autopilot to enter into the market. Now, if you guys are interested to know when we are going to be entering in and adding to our positions, we have really kind of gone silent when it comes to our actions here in the market. We're waiting for the trend to reverse here. If you guys want to know when I'm going to be making those additions, you can always sign up for the Dash Report. It's a newsletter we run here on the channel. We just dropped our latest edition a couple of days ago towards the close of the week. And a lot of people have been responding positively to the articles that we write, as well as our general sentiment on where we think price is going. We cover crypto, forex, equities, as well as commodities, give the whole macro picture. And most importantly, we have our trade alerts group here, where I'll tell you guys when I'm making those big moves, focusing on the longer term moves in the market. So if you guys are interested, check out the link down below in the description. You can get a big discount signing on to an annualized basis. But even if you guys don't want to do that here, I want to dive a little bit into some of the short-term analysis here, because I know some of you are probably curious about what's going to happen over the next coming days and possibly the next week. I know a lot of people who all the while they may completely agree with me that we're going to see a lower turnover in price here, that we're going to turn over and start rolling lower. It is important to note that you should not try to short this range on intense amounts of leverage. There are many people who are thinking the exact same way here, that, oh, I'm going to go ahead, set up my short entry here. I'm going to set some kind of stop loss up here, and I'm just going to likely ride the wave down. And while we do believe that price is likely going to go down here over the next coming weeks, and we will get a lower print in price, probably having one of our last major corrections before we begin consolidation, depending on how much we sell off, there can easily be a short squeeze here, like there was the other day. These candles may not look like much, but a lot of people are building shorts down here at 18,000, and if you are using any degree of leverage here, for example, like a 10x leverage or 5x leverage, you are either going to face immense paper losses that many of people will probably materialize and therefore lose a huge chunk of money, or get liquidated and lose your entire position. Don't try to short a bottom or try to short essentially a very heavily sold off market. That's not the smart thing to do. At this point, we should be waiting for entries into buying opportunities. We have to wait until the market signals confidence that the bulls are in charge here. It doesn't make sense to start shorting here. When shorting starts to get popular, that's when you know it's time to run for the hills. Okay. Same thing here with Ethereum as well. If you take a look at the hourly chart here, we could get a retest here of like the 1 hour 200 EMA coming up towards this kind of typical range we've been seeing here for the past 4 trading days. But again, this is like short-term trade setups that don't really yield much opportunity. I would wait and try to get the big kahuna. Some of the best traders I know that I followed in traditional markets, who I followed in crypto, they really make only 2 to 3 trades a year. They make those sizable trades where there's confidence, there's back testing, and it follows generally with the trend that's already in play, right? So again, it's a matter of remaining patient here until we see that trend reversal. Now I want to go ahead and talk a little bit about equity markets here, because I know a lot of people probably watch similar indicators to what we watch here on the channel. One of those is the 200 EMA, and when we take a look at the weekly time frame across the indices, we start to see that we've revisited towards typical correction territory here. And this has gotten a lot of people optimistic that we could be in value territory here. For example, back in the March 2020 correction, although while we did break below there, any entries around this point were swiftly put back in the green as monetary stimulus kicked in. We saw back here during the December 2018 correction, we also covered here on the DataDash channel, buyers came in, drove up price higher. We see back here in February of 2016, buyers came in. Back here during September of 2011, a little bit of chop under there, buyers still came in. And back here as well here in 2010, in 2011, we saw buyers coming back in, driving prices higher. But I want to point your attention here to the fact that back during the 2 heavier corrections or bear markets that we had here back in 2000 to to 2002, the dot-com bubble collapse, as well as the 2008 recession, we had many times where we came up around this range, buyers drove price higher above the 200-week, having essentially a dead cat bounce or fake out, where we eventually rolled back below it here on a more extended bear market following an economic recession. And that's the important thing to understand here, guys, is that all the while we were likely going to get a real recession. And I'm talking about a 40-50% correction back in March of 2020. The Federal Reserve decided to delay that. They essentially stimulated the economy with an awashment of cash and lowered the base interest rate of the Fed funds rate in order to keep credit extremely cheap in the economy. These two things prolonged the effects, or essentially postponed the effects, if you will, of a real recession, which we have really not had here throughout this entire period of time. We have had periods where the market gets spooked and we have these 25-30% corrections, many of which are where buyers have come in here over the past decade, during this easing period of monetary stimulus where the market could easily rely on the Fed, but the Fed is clearly showing that it has left the room. It is trying to cater towards treating inflation, and it is going to extreme lengths to do that in order to essentially put the economy in a recession and cut demand, because it knows that it can't do much to really tackle the supply side economics of commodity shortages that are driving prices higher. So I think it is more likely than not that we could get a nice little rally here maybe into the summer, but it will soon be followed by a continued correction lower here. And we have our targets we've been talking about here on the channel. We go a bit deeper into that within the Dash report if you guys are interested to dive into it. But again, focusing here on a much grander correction rather, or in this case, a recessionary bear market versus your typical correction of 25-30% over the last decade. And again, we'll talk about if we make any entries there on the Dash report. Outside of this, well, same thing here in the NASDAQ, right? This has been the go-to area to buy here. And all the while, if you want a dollar cost average a little bit, I can tell you guys my actions, I hope, speak louder than my words. We are not scooping up a lot of equity positions here. We're not rushing into it. I am being, in this case, very conservative with my dollars. In this market where dollars and cash is king, I'm not rushing to buy any assets. I'm waiting for the market to come to me. And you should always be doing that when it comes to opportunities here. You should wait until the market gives you the signs that, yeah, okay, it's at a favorable point. I have a much better risk to reward ratio by entering in now than I did a couple months ago. And there is good potential over the next 6 to 12 months here for my position to yield a return. That makes sense for me to park my money in this asset. Right now, we do not have enough signs of confidence here. In fact, if we continue to extend here, and I think I'd watch the NASDAQ here, which has really been facing a lot of the pain as it's been the market leader for the past decade. If you see a lot of chop below this 200 week, that could be your sign here that we've got a further roll down here. I'm not saying dot-com era level sell-offs here where we collapse absolutely, like I think around 80% generally in price. I'm not saying it needs to be this bloody, but something around a 40-50% correction, which would outweigh any of the corrections we've had back here over the last decade. I think that is what's likely in the cards here. Now let's go ahead and take a look at commodities, which are backing up this thesis here. You've got light crude oil futures here. The price of oil essentially still making higher lows here. And I know a lot of people, as you guys know, would talk about, just because we're making higher lows here doesn't mean it's a sign of confidence, but it also doesn't mean it's a sign that we're rolling over here. Until we really get a substantial trend reversal sign in price, we have to remain neutral. We have to understand that the broader trend here is that oil is trending higher here. And right now, it looks like we're building in a nice wedge here on the weekly chart as far back as the beginning of this year in 2022. Unless we get a significant breakdown below these lows here at 95, I'm not too confident that this is going to start cooling down soon. I'm going to wait, and I want to make it very clear here that you are going to see oil signal here bear market signs well before Bitcoin starts really substantially trending higher for the next bull market. So that should be a bit of peace of mind here that we don't need to rush into anything. If we see oil break above this and start to retest back up to $131, that could be a major capitulation sign, essentially meaning that equities are going to go lower. Same here with natural gas, right? we've had a cool down here. We've went from 9.6 here on natural gas down here to 5.6. We've remained neutral in the newsletter on this because all the while this looks like a clear top, a 20% move downward in a week and 3 following weeks of downward price action. All the while, we may be confident that this looks bearish. We have not seen a break of the long-term channel that natural gas has been riding in from 2020. And this, alongside oil, is one of the big reasons why inflation has been so bad here. We've seen a cool down in the rise of food prices. We are not seeing it in commodity prices for energy just yet. Now I want to go ahead and dive into an area that we don't always talk about here on the macro report to close things off here. And this should just signal as a sign here that we are about to enter into what may be a very volatile period across financial markets. Something that typically happens when equity markets, when the housing market, when the entire economy is going through major structural changes in the way that we value and perceive value in a variety of assets. And that is the major pivotal shifts we could see here in Forex markets. Now we have an extended higher target here for the Dixie. This is the dollar index, measures the dollar's performance against a basket of the major currencies in Forex markets and provides an overweighted score here of how the dollar is performing and a broad perspective against these other currencies. And really since back here in 2008, the dollar has been gaining strength here. We've had some periods of chop along the way, but generally speaking, like in the past, we have seen the dollar trending higher here. And we tend to find this here over multi-decade periods here, multi-decade setups where the dollar is gaining strength or losing strength against other currencies. Now, all the while here, we're taking a look at the quarterly chart. So this is giving us, its general performance since as far back as the 1960s. I want to go ahead and dive into the individual dollar pairs here that we're taking a look at. Take a look at the euro to USD, right? So essentially, if this chart is moving downward here, this means the dollar is gaining strength against the euro. We are down at levels not seen since February and March of 2015 and December of 2016. This is a pivotal point here for the euro, because if the euro breaks this neckline here, this neckline of support that we have not seen since as far back as 2002 when the euro was gaining strength, you can assume that the euro is likely going down at a minimum to the 1 point range here where 1 euro equals $1. And this is just again signaling how far we've come here in the change of Federal Reserve monetary policy versus the ECB, the European Central Bank, and just how much the ECB has fallen behind on this game of tackling inflation and being able to cut back its monetary stimulus. If the Fed keeps chugging forward and the Fed is able to leapfrog much further from the ECB as it already has done, this is just going to collapse us lower and may even put us into really bearish territory here for the euro, coming down here into this range we saw back in the early 2000s. Take a look at the US dollar to the Canadian dollar here, right? Because the dollar is the leading pair, part of the pair here, right? If we trend higher here, the dollar is benefiting. Take a look at the ranges of support here. Buyers came in, buyers came in, buyers came in 3 times in a row here. At a minimum, we would expect here that the dollar is probably set up here to, in the coming months or year, come up back towards the 1.45 range here, meaning for every US dollar, I'm able to purchase $1.45 of Canadian dollars. Again, signaling further strengthening of the dollar and weakening of other global currencies. And a worst case scenario here, I think, is coming up here towards this 1.6 range. And if we get that, again, this is going to be a major shakeup in Forex markets here, just like we saw back here in 2015 or back here in 2008. You tend to get these kind of moves during recessionary periods. Make sure to focus on that, right? Even here during the collapse of the dot-com bubble, afterwards leading towards a major spike lower in the dollar strength against the Canadian dollar. We see these pivotal moves here depending on how central banks react to recessionary environments. Take a look at the USD against the Great British Pound, the US dollar focused up against the pound here. This is the annual chart. Each of these candles represents a year. We're taking a look as far back as the 1990s. I want you to look at this chart here. When we get this cup up in price here, we've seen this pattern happen before. A very similar setup here over the past decade here. What happened last time? We had a major move higher. We also had a similar pattern here in the past. And all the while we didn't have the same breakout we had over here for example, where we got a nice 19% move year over year, we still got closed above the highs here. Essentially, we were able to have a nice rally higher above this range, a solid breakout, which gave us an opportunity where the dollar garnered strength. No matter how it plays out here, history showing us that the dollar is likely in for some more gains to the upside, causing a further squeeze on global markets. If the Japanese yen on the monthly chart isn't telling us this already, it's about to. It's about to show us that we're at a minimum coming up here towards 147 on the ratio. And if we get above that, really the sky is the limit here. The Bank of Japan is a far-reaching example of just how far behind global central banks are comparative to the Fed when it comes to monetary tightening. Japan has barely even started and is just starting to have significant conversations about taming inflation. This is a major difference here, and you can start to see how central bank monetary policy plays out on these currencies. And then you've got the already weakened currencies here, like the Turkish lira, which have caught the world by interest here. All right, and we can see that it's just continuing to lose value here. This is the log scale, so if you put it into standard, you can start to really see how much this is starting to hit economies like Turkey. And inflation, although some people would have hoped that this would start to cool down, this has just continued higher here. Now, there's a lot of other currencies here that we're going to be keeping an eye on, from the Brazilian real, a lot of emerging market currencies that could start to show an effect of contagion, essentially, where we're starting to see more and more currencies collapse and lose trust, and a lot of central banks and federal governments trying and attempting to fund deficits and stimulate their economies, but unfortunately to no avail, not being able to do so, and also getting reaped by the effects of inflation. But the major thing here is this: as we're going through this macro environment here, we're going through a period of time that Bitcoin hasn't really lived through. And that's something, to be completely fair, that some of the people who have been on this narrative that we're in a bear market for a long period of time have brought up. It's a very fair point. We have not seen Bitcoin go through a mass of currency crises across the world. We have not seen Bitcoin go through a typical 2008-2000 styled correction in equities. We don't know what that's going to look like here. And until we really get a solid setup here that makes sense for us to enter, why would we rush into it? That's going to be it for this week's macro report, guys. Again, if you guys are interested, you can always check out the Dash report, which just dropped. It does a good coverage on all these topics. We'll let you guys know when we make these entries here. We're keeping conservative. We're waiting patiently. And again, I want to emphasize that point again. The best traders I know really make about 2 to 3 trades a year. They don't make a lot of trades, so they don't try to do too many moves, and they usually are trading some of the more liquid, safe, predictable assets like Bitcoin and Ethereum. So for that matter, we're going to wait, and I hope you guys enjoyed this video. If you liked it, drop a like, leave a comment down below what you think, whether you agree or disagree. I want to get a conversation going down below in the comments. But until the next video, thank you all so much for watching, and I'll see you all in the next one. Take care, everyone.